Hi, my name is David Johnson, and I'm a mortgage banker. And today I want to talk about asset depreciation, also known as asset depletion, for those of you out there that have retirement accounts, 401ks, investment accounts, or just liquid assets in a checking or savings account. You can actually use that towards income qualification. This is something that retirees use quite often, but it doesn't necessarily have to be used by retirees. Anyone can use it. The way it works is I take the balances in your accounts and I divide that by the term of the mortgage. So if it's a 15-year mortgage, I would take the balances in your account and I would divide that by 180, which represents 180 months. If it were a 20-year mortgage, I would take the balance and I'd divide it by 240. The most common use is a 30-year mortgage, which is 360 months. And whatever that number is the amount that I can use towards your income qualification. And I'm going to show you two examples in this video later on, so you can see how it actually works and how the numbers are actually calculated. There are several different mortgages that this type of asset depreciation can be used on. Fannie Mae has one, Freddie Mac has one. I actually have some portfolio options which are for jumbo loans, which with retirees buying second homes is often the case. It's a larger mortgage amount. They can be used on primary residences and second homes. Currently, they can't be used on investment properties. And the loan to value, which is the amount that you're borrowing compared to the sales price of the home, has to be at least 80%. So the down payments on the asset depreciation mortgages are minimum of 20%. And with Fannie Mae, depending on your age, you might have to put 30% down. So in the first example, I have a borrower who's 63 years old and they have $150,000 in a retirement account and $99,000 in a money market account. And that totals $249,000. When I take that $249,000 and I divide it by 240 months, that would contribute $1,037.50 to their income. That doesn't sound like a lot, but this person, and normally it's the case when I work with these types of customers, potentially would also have Social Security income that would contribute to the asset depreciation. They might have a pension, which is really common with retirees. So the asset depreciation is just one form of income that helps them have more income towards qualification and afford a more expensive home. Another example is a borrower with $1,200,000 in a retirement account. And when I take this amount and I divide it by 240 months, it's actually a larger amount towards income. It's $5,000. So you can see where this is an additional $5,000 that the borrower can use towards qualifying for a mortgage that they're not making in income. And the nice thing about the asset depreciation is you don't actually have to deplete your assets. It's just, from an underwriting perspective, liquid funds that are there that if you did have to make your mortgage payment, you could take funds from this account to make your mortgage payment. So that's what makes it possible to use assets towards income qualification. Now, I've also used this on people that have $5 or $6 million in a retirement account or in an investment account. Now, in this case, you're really able to use quite a bit of income towards your qualification and afford a multi-million-dollar home, because the amount in the assets when divided by 240 months is, $10,000, $15,000, $20,000. And these borrowers don't work. They are retired, they are enjoying their life, and they're able to get a home this way, whereas otherwise they wouldn't be able to, because they don't have other forms of income other than Social Security. So someone that isn't working and doesn't have other forms of income would be restricted in the amount of home they could afford based on Social Security, whereas if they have millions of dollars in a retirement account, now they can actually use that towards qualifying for a dream home or a dream second home. In conclusion, that's what asset depreciation is. It's a really wonderful way for someone who is retired or someone that has funds and retirement accounts or investment accounts or even money market accounts who want to be able to qualify to buy a home but don't have sources of income to qualify for them. And that's what I wanted to talk to you about today. I appreciate you watching this video. And if you did get anything from this video and you enjoyed it, please like the video and have a wonderful day. Thank you.